Welcome to the Lane Gorman Trubick COVID-19 Financial Webinar Series. In this series, our accountants and advisors will provide you with information to make sure your business has the tools it needs to survive the 2020 coronavirus lockdown. This webinar is about Texas's state and local tax response to COVID-19. It was recorded live as a Zoom webinar on May 5th, 2020, and all information was accurate and up to date at that time. There is a Q&A at the end, but if you have questions, please feel free to email us at askus@lgt-cpa.com, and we will get back to you as soon as possible. Thank you, and enjoy.
Good morning, I'm Katie Lyles, our Events and Marketing Coordinator here at Lane Gorman Trubick. I want to welcome you to the second SALT webinar of 2020. It looks like we still have a few people joining us, but I just wanted to start today telling you a little bit about us. Today we will be discussing COVID-19 update for state tax and Texas audits presented by John Wellington. We are excited to be offering a diverse selection of webinars in 2020. LGT is a mid-sized accounting firm for all business sizes, and in 2020, Lane Gorman Trubick will be providing you with endless CPE content. These events are created to help your business grow and thrive. We cover a broad range of topics that are impactful to businesses in the construction, M&D, healthcare, dealer services, real estate, and not-for-profit industries this year. But we always want to make sure we are providing you with the topics that you need more information about. So make sure you fill out the evaluation after the event and leave a comment with your suggestions. For any financial updates related to COVID-19, please visit our LGT homepage at lgt-cpa.com to find a link to our COVID-19 financial resource page. This is regularly updated to show content that is most relevant to you. This webinar will be available as a recording within 24 hours of the event. The link to our COVID-19 YouTube financial updates playlist can be found on our resource page, social media, and in today's chat. If you have any questions about this or any of our services, or would like to set up a free consultation to determine how we can help your business and organization, please send us an email at lgt-cpa.com. All of these links will be included in the chat. This is a continuing professional education event, and you will receive 1 hour of CPE credit upon your completion of your class evaluation. Immediately following the webinar, our SurveyMonkey will pop up in your browser. To ensure that you receive CPE credit, please take this survey after the webinar. However, in a case that you do not take the survey and close out of it, no worries. You will receive an email with the survey link from LGT via Zoom within 24 hours containing that link, as well as the link to the recording that will be available in 2 days. Please take the survey to gain access to the presentation material as well as your CPE certificate. A quick legal piece before we get started, and then I will introduce our credible speaker for today's presentation. This material contained in the presentation is current as of the date produced. The materials have not been and will not be updated to incorporate any technical changes to the content or to reflect any modifications to accounting services offered since the production date. Any advice in this webinar is not intended or written by LGT LLC to be used and cannot be used by a client or any other person or entity for the purpose of avoiding penalties that may be imposed on any taxpayer, or promoting, marketing, or recommending to any party any matters addressed herein. With that out of the way, I'm excited to introduce John Wellington, leader of our state and local tax division at our firm. John is a licensed attorney that has spent nearly 25 years serving the public, specializing in matters unique to state and local taxation, SALT. John is the leader of the firm's SALT practice. Drawing on experience working with some of the largest accounting firms in the world, John's experience in SALT Matters include audit defense, income and franchise tax planning, sales and use consulting, nexus studies, and property tax minimization. John is exceptionally well versed in the SALT needs for clients in the construction, manufacturing, distribution, and not-for-profit sectors. Without further ado, John.
Thank you for that introduction, Katie, and thank you everybody for taking some time out of your day to listen to this webinar. As Katie nicely put, today we're going to talk about Texas and other states' responses to the COVID-19. This is the disclaimer that she read to you. I would only just emphasize, as you could probably think that these things are changing very rapidly. Some of the slides in this presentation I updated this morning to reflect things that changed, and fully expect things will continue to change, as facts on the ground warrant, and as all the states decide to handle these things in their different ways. Just real quick, we as a firm, LGT has done a number of webinars and provided a number of other resources with respect to COVID-19, and as she mentioned, the webinar will be up on YouTube. Here's a link to our resource page, which contains links to some of those webinars, some other resources, and some other insights that are, from our practitioners. And I would encourage everyone to take a look there if you have any questions after this webinar about anything else related to COVID-19. So today, we have a fairly, simple, straightforward agenda. We're going to talk about how the states are reacting to what's going on in the world with respect to COVID-19. We'll go pretty in deep on Texas's response, kind of just explain, more broadly how other states are reacting. And then at the end, I want to talk about something known as Public Law 86-272, which if you've heard me speak or you're, well-versed in state tax, you might know about. But if you are fortunate enough not to have to deal with those matters on a regular basis, you frankly may never have heard of, but I think that's going to be one of the main things driving what's going to affect taxpayers in the future. And I think that's going to be even more driven by the consequences of what's going on now with the virus. All right, so let's talk about Texas. Just to give everybody a feel for how Texas operates financially. You can see here from fiscal year 2019, Texas took in about $60 billion in tax revenue, and over 57% of that comes from sales tax. And if you look at the other numbers, you can see about 10% comes from oil and gas. And so those two drivers of tax revenue are also two of the areas that are going to be particularly hit due to the virus. Just the other day, March sales tax is due April 20th, and so the comptroller only recently announced the results of those collection efforts for March. You can see March sales tax collected was about $2.6 billion, which is down just under 10% from March of last year. And knowing what our experience was, with basically, I'd say the first half of March, things were fairly normal. And then the second half of March, things were pretty shut down. So we can fully expect April to be worse than March. How much worse, obviously, is anybody's guess, but we could certainly imagine it's going to be, just as bad or, a greater, decline from March and from obviously April from last year. And obviously other tax types are also dramatically affected by the virus as well. As you can see, motor vehicle taxes were down the most in history. Oil and gas production taxes were down about the same. Hotel occupancy taxes, as you can imagine, were down dramatically. And so these are going to continue to have consequences in future periods as well. But this gives you a feel for, this is basically all we know so far. And that also means that's all the comptroller really knows so far as well. So what has Texas actually done, comptroller actually done in reacting to the virus? Well, for franchise tax purposes, as most of you may know, franchise tax returns are generally due May 15th, 10 days from now. And then most taxpayers, if you're a small taxpayer paying under 10 grand, you would then be able to have a 6-month extension to November 15th. So what Texas has done is now said that that May 15th deadline is pushed back 2 months for non-EFT filers, which are those small taxpayers, pushed it back 2 months to July 15th. And just as you could get a 6-month extension under normal circumstances by filing an extension with payment, that holds true for the July 15th deadline as well. So naturally, that 6-month extension, instead of taking us to November 15th, will take us to January 15th of next year. A valid extension payment has to equal either 90% of your current year's tax liability or 100% of the prior year liability. All of that is the same as normal. EFT filers, again, those would be the larger taxpayers who have to file electronically. They have a slightly different method for their extensions, but big picture, their returns are not due till 7/15. They make an extension payment. They only get this 1-month extension, which is to what would normally be the regular extended due date of 8/15. And just like other taxpayers, if they go ahead and submit payment with that by 8/15 of their full tax amount, they could get that 6-month extension till next year, just like any other taxpayer. And that's all the relief that I'm aware of for franchise tax. There's no other consideration going on that I'm aware of to do anything else. On the sales tax side, I mean, here we're sitting here in May, but with respect to March sales taxes, a lot of taxpayers were not necessarily able to make payments due to the dramatic fall in their revenue, in March and April. So what the comptroller said is for March, if you're a taxpayer, you basically, if you could come forward and plead your case to the comptroller, taxpayers were offered short-term payment programs and with waiver of penalty and interest for the late payment of any March sales tax. This wasn't something automatically granted. You need to make a good faith effort to pay and contact the enforcement division. If anyone out there still hasn't paid their March sales taxes, I would say to go ahead and try to do, make that call to enforcement and see what relief is still available. April sales taxes, which will be due here May 20th and for future periods. Right now, there's no relief either with respect to payment or extension of due dates. Right now, everything is just business as usual. With respect to motor vehicle sales taxes, those are typically due when the dealer would title the vehicle and register the vehicle. So now they have up to 90 days to do so. Buy here, pay here's wouldn't be affected by this because they wouldn't be paying the sales tax up front. Okay, let's say you're being audited by the state of Texas. Regardless of tax type, all audit offices, all field offices of the comptroller are closed right now, but that doesn't mean auditors are not working. They are working remotely, and they are, to the extent possible, continuing to do their jobs. So, a big emphasis or a big part of an audit is providing documentation to an auditor. And there's natural new obstacles with respect to that. Obviously, if you need to physically obtain documents and there's somewhere that you can't get to, then you just simply can't do it. And so, auditors are showing, compassion for that and understand that. And if additional time is needed for that, so be it. As a practical matter, most taxpayers are, fairly online and have a lot of access to electronic information, and so a lot of audits basically are continuing business as usual. If you've already completed an audit and you've received or are about to receive, a notification of exam results, the bill from the comptroller, typically you have 60 days to protest that audit assessment. That 60-day period is currently suspended. I can't tell you when that will change. But during this period in which that window is suspended, no interest will continue to accrue on any liabilities. The comptroller will notify taxpayers once they have figured out exactly how they're going to handle this on a go-forward basis. and you could expect to be notified by the comptroller when that happens. If you currently have a payment plan with the comptroller, you can ask them for relief, postponement of payment, or any other kind of alteration of your agreement. But that's just being handled on a case-by-case basis. I can't really give you any clarification on what you would have to show or what you would have to do. It's worth pointing out that in the comptroller's guidance with these delays and the suspension of the protest window, they don't specifically address jeopardy determinations. Those are when an auditor basically has some concern that a taxpayer isn't going to pay. Instead of getting the regular bill, they get what's known as a jeopardy determination, which has a shorter period to respond. Those are not specifically addressed in the comptroller's guidance on their response to the virus. So I would say with respect to that and with respect to any other tax liability, if it's not clearly identified that there's some relief being granted, err on the side of caution and assume that there is no relief being granted. And obviously, how you choose to act from that point going forward will be up to you, or feel free to reach out. And it's certainly worth trying to talk to the comptroller about getting some mercy if that's what you need. Don't forget, inside of Texas, there's lots of local governments that also rely on tax revenue. And the two biggest sources of tax revenues for cities and counties are property taxes and sales taxes. Sales tax usually comprises about 30% of a city's revenue. And when you couple that with all the sales tax revenue they're losing from the lack of activity at airports, the empty convention centers, and basic drop in tourism, you can expect the local governments to be hit just as hard, or if not harder, than the state. And obviously consequences are going to stem from that, and what those will be we'll have to see. But it obviously will not be a surprise to see a lot of local officials be laid off, or services being reduced or eliminated. So sales tax is one of the big drivers of local tax, but certainly the one that most of us think about. Sales tax is administered by the state. So that's, all of the consequences of how to handle your sales tax for local purposes just naturally flows through from the state's response. With respect to property tax and taxes, those are locally administered by the appraisal districts. So I don't want to say every appraisal district is the same for these purposes, but it's probably the case that they all look pretty much like this slide. And so I would basically read this top part to you. This is a notice from the Dallas County Appraisal District. I've eliminated some of the language. It starts out saying, their offices are closed. But I think it's worth just kind of going through what they say here, because it should hold true throughout the state. So the appraisal notice and protest process is under review, and the timetable has not yet been determined. Once appraisal notices are released, then the protest deadline will be 30 days from that date for everyone, even if you don't get a notice. When they mail the notices, they will place all notices on their website for all accounts. We will update this alert in our recent headline with the timetable when it has been determined. I could tell you I looked at the website this morning, and in this message is still there, so there's been no change. The DCAT encourages property owners and agents to conduct business online, and they will be able to process those online filings even though the offices are closed. So, anything to do with protesting property and getting your assessments right now, it's just up in the air right now. But what I can tell you, and this is true for all appraisal districts, is that the rendition statements that are typically due on April 15th for business personal property, those deadlines have been moved to May 15th. And Freeport exemption applications, that's for property that's only in Texas for less than 175 days, and then you send it out of state. Such property is exempt from property tax. And the deadline for those applications has been moved back a month to June 15th. Now, there's a couple of quirky things about property taxes. Some of you, you might have listened to my state tax summary of the 2019 legislature. And one of the things they did there is they enacted this new section 11.35 of the property tax code. And what that did is it offered property tax relief for property that had been damaged by a disaster. that was specifically enacted thinking about Hurricane Harvey. And so a natural thought is, well, COVID-19 is a disaster, and therefore, and I don't mean that, jokingly or lightheartedly, but, there's been a disaster area declared for the state and in all, counties. So taxpayers naturally might be thinking that there's an opportunity to reduce the property tax on such property that have been damaged by this disaster. And the way that this section works is that depending on the amount of damage, there's a formula for what percentage of the value of the property can be exempt. So the Attorney General proactively released this opinion. If it wasn't last week, it was the week prior, basically saying that although this section of the tax code provides a tax exemption for disaster, the court would likely conclude that the legislator intended to limit the temporary tax exemption to apply to property physically harmed as a result of a declared disaster. And therefore, this economic non-physical damage caused by COVID-19 is not eligible for this exemption. So they are basically, this is the Attorney General speaking, right? This is not a court issuing a ruling. This is the Attorney General saying what they think a court would do. So this is not binding on taxpayers. It is certainly, I would fully expect this issue to be litigated, but it also means that to the extent you wish to take advantage of this, even if, right now they're telling you it doesn't apply, it's something that you would want to think about when you ultimately, when the protest process opens. This is something to think about, even again, the fact that right now, they'll turn you down, right? And it would have to be challenged in the courts. And that's pretty much what the slide goes on to talk about. Keep in mind that property is assessed as of January 1st of each year. So that's obviously before, the shutdown, which we call sometime in March. So really, as of 1/1, there's a good argument, certainly from the appraisal district side, that COVID-19 had little to no impact. Some appraisal districts have talked about just freezing values at 2019 values, but that's all it is right now. It's just a discussion. That doesn't mean that's what's going to happen. And it's, with respect to the protest process, that typically involves the taxpayer going before an arbitration board, the ARB, which is comprised of citizens of that district. And so there's going to be obvious challenges just from a logistical perspective on how exactly that process is going to work and who the heck is going to sit on these boards. So those are concerns for another day, but they're coming. So for these purposes, Texas is saying that, the damage from the virus is not related to the disaster, or, you're not eligible for this exemption because this disaster didn't cause any physical damage. Well, in 2019, the legislature also passed another bill, now known as the Texas Property Tax Reform and Transparency Act. Back then it was known as Senate Bill 2. That provided a bunch of reforms and modifications to the property tax process. And one of the things that it did do was it lowered the tax rate that a taxing unit can adopt without voter approval, meaning that they can't just, historically, they could jack it up to 8% a year. They could increase the tax rate 8%, the rate could go up another 8%, not to 8%, but 8% higher without any voter approval. This was known as the rollback rate. And so what this legislation did is said, well, no, you can't raise the rates 8% compared to last year. From now on, you can only raise the rate up to 3.5% absent a vote. So that's great, and that was favorable to taxpayers, but there was a notable exception in there that said no election is required if any part of the district is located in an area declared a disaster area during the current tax year by the governor or by the president. Well, that section of the property tax code goes on to define the word disaster, and after volcanic activity, it mentions an epidemic. So you can clearly see that localities may have an argument that they can raise their rates 8% higher without a vote, as opposed to the otherwise 3.5% ceiling. I'm not saying this is going to happen. It's something that could happen. Obviously, all these decisions are going to have to be made And by the time the localities have to set those rates, it's not for several months. So they'll have some more data behind them to get a feel for exactly what the damage is from the loss of sales tax and everything else when they set the rates. But it's certainly setting up for a lot of confusion and litigation in the property tax world going forward. That sums up first part of the seminar, talking about Texas's response. So the first CPE question: due to COVID-19, A, rendition statements are now extended until May 15th. B, franchise tax reports are extended. C, deadlines for audit protests are extended. Or D, all of the above. Hopefully most of you came up with the answer, all of the above. Okay. Oh, here's a little check-in. I don't know if you're all, I am watching, but I can't vote. I don't know if you can see this on my screen, so I'm gonna move to the next slide. All right, so we talked about Texas. So what else is going on in the other states? Well, again, let's just keep in mind kind of the big picture here. You know, the federal government has the ability to borrow as much money as they like, whereas states have to balance their budgets and have a limit on how much, on their ability to take on debt and their requirements to, you know, pay existing debt. So they don't have the flexibility that the feds have to say, hey, don't worry about paying us, you know, pay us later, pay us over time. They are much more reliant and, you know, they just don't have the flexibility to give relief to taxpayers in the same way that the federal government does. So states are doing obviously all sorts of things, just in, you know, along the same lines as Texas. We'll talk about some of it in the future, you know, in the next few slides. But here's a link to the AICPA. They're keeping a matrix of all the different state tax relief. Every time I've gone on that website, it was updated that day. So I think it's safe to say it's fairly, you know, it should be up to date and pretty comprehensive. So it's a nice resource if you're looking for those kinds of questions, you know, answers to those kinds of questions. Excuse me. So as we know, the federal returns are now due July 15th. Those were extended, and therefore the states have all followed the IRS's lead and extended their due dates to July 15th as well. No interest or penalties will apply to any payments that are not made until July 15th. And states have also pushed back some due dates with respect to some other taxes. You know, estimated payments, some states have pushed back as well to July 15th. And some states have quarterly, you know, they have non-income taxes that are due on some other basis with the state. For instance, Washington has a business and occupation tax that's paid quarterly for most taxpayers. So those that were originally due in April are now pushed back to June. And the annual returns from 2019 that were originally due by now are now pushed back to June 15th as well. With respect to sales tax, you know, obviously I'm not going to go into every single state, but lots of states have granted some sort of relief with respect to February, March, and April. And for the most part, that's about as far out down the line as they've gone. California has been pretty generous. They said if you're filing returns with $1 million or less in sales, you get an automatic 3-month extension for any sales taxes that are due through, you know, through July 31st. Similarly, North Carolina has said any tax returns that you owe, you know, in the first half of the year are all due July 15th. You know, so some states have similar relief, and sometimes they may require a taxpayer to show that they're not just, you know, taking advantage of the situation, but they've actually been down, you know, they've been impacted negatively by the virus. So, you know, before you assume that you are eligible to take advantage of any of these relief provisions, you know, make sure you qualify for them. You know, we're used to Texas, where Texas has no personal income tax, but most states do impose a personal income tax. Well, you got to think about it from a business perspective that your employees that are not working in your office, they're now working at home or elsewhere. And that elsewhere may in fact be outside of Texas. You know, someone might be taking care of a sick mother or any other circumstance where instead of sitting at their home in Texas, they might be sitting in Oklahoma or Louisiana or any other state. Well, that has consequences to you as a business. The presence of an employee in a state where otherwise you would not have had a presence might create a sales tax collection responsibility. It might also create a corporate income tax filing responsibility. I'll talk about Public Law 86-272 down the road, but depending on what that employee does for you, they might create an income tax filing even if you previously had this 86-272 protection. And then there's withholding questions on personal income taxes. Are you supposed to withhold on that employee for that state? And so those questions also have to be answered. And it also has an impact when you go to do your returns next year. All of a sudden, you know, instead of assuming all your property and payroll is inside of Texas, some of that is going to be elsewhere than it used to be. And that naturally needs to be reflected on tax returns to the extent that they impact your filing positions. So as I mentioned, you know, a lot of people have people working from home now, which is unusual to them. And so some states have addressed this issue specifically, and they've said that even though typically, you know, having an employee in a state doing work would create nexus, they've specifically said, no, it's okay. We're not going to call this a nexus creating activity if it's just because, you know, you're having those people there due to the virus. So here's a few states that have taken that approach. Mississippi specifically said, you know, basically the same thing with respect to their income apportionment, as I alluded to on the previous slide. And in Ohio, there's all sorts of local tax filing responsibilities, and those have been, you know, they've offered some relief for folks who have people working at home in Ohio. So you can see there's all kinds of different ways that states can be dealing with this stuff. So let's talk about how the state's reaction to some of the, you know, the IRS actions and the congressional actions, specifically with respect to the CARES Act. In normal times, states interact with the Internal Revenue Code, the IRC, in a number of different ways. They don't necessarily just follow everything that the IRC says as of today's date. There's three kinds of ways in which states adopt the IRC. Some of them say we follow the code as of, you know, the present date. Some say they follow the code as of a certain date, and therefore any changes to the code after that date are not reflected in how you would compute your state income tax. And then some states are selective, where they'll just kind of adopt the code as of a certain date, and then they'll also decide to adopt certain provisions of the code. You know, in 2017, after the Tax Cuts Jobs Act, most states did something with respect to their conformity statutes. You know, some of them date back to, you know, 86. So most states updated their conformity provisions in a number of ways, in these three different ways that I just referred to. And now states have the additional burden of figuring out whether to follow the CARES Act provisions. Just as an example, you know, the 2017 Act imposed a business interest expense deduction limitation of 30% of your adjusted gross income. That limitation was increased to 50% under the CARES Act for last year and this year to offer some relief to taxpayers. Well, even back in 2017, not every state decided to follow that provision exactly. And further, with respect to this more taxpayer-friendly provision, states have to decide what to do about it. Specifically, New York has already looked into, you know, provided some guidance on their 2021 budget, and they definitely are decoupling from the CARES Act provisions in certain ways, including this one, that they are not going to adopt the 50% change for their purposes. So all the states are going to have to deal with these same types of issues. And of course, the states, you know, are suffering, just as I've probably said several times, and as everyone knows, that, you know, just the economic damage is just too much to just simply be able to solve with an easy solution. Just last week, Moody's announced they expect a $160 billion loss in state tax revenue between 20 and 21. And as I mentioned, they have to balance their budgets, and states typically use a June 30th fiscal year. And so that means that in the next few months, that's going to be when their legislatures meet. That's going to be when they're making their decisions. And obviously, they are going to have to make tough decisions. But you can expect those decisions to involve more revenue for the states any way they can figure out how to get it. So you can expect tax rate increases, expanded tax bases, and more aggressive audits of out-of-state taxpayers. And one other consequence could be the elimination of Public Law 86-272, which again, I'm going to get to. I mentioned I pulled the news is changing every day. This is just some news I pulled yesterday. I'm not going to go through all of these, but just to give you an example of the ways and the things that the states have to think about and how they react. Connecticut might abolish some relief that they plan to give to taxpayers. Rhode Island, just to give you a feel for the magnitude, said CARES Act Conformity would cost them over $50 million over the next 2 years. New Jersey's thinking about offering some relief to taxpayers. Vermont is making it easier for local governments to do their job without having to, meet in person, for health reasons. And then Philadelphia suspended some proposed or scheduled tax cuts, and Michigan's trying to help out first responders. So you got so many different ways that this virus is affecting people and the states, and so many different ways in how they are trying to handle the consequences of that. Well, it's not all bad news. At least in my opinion, I feel like states are also going to have additional motivation to get the tax revenue, and that might make them easier to deal with in certain circumstances. You might have an ongoing dispute with the state where they might be willing to kind of solve it just to get it, to get the cash in the door. That you certainly might want to consider voluntary disclosure agreements. Sometimes those have some discretion or negotiation involved with them. I think that, taxpayers might be in a stronger position there. Suggesting a payment plan to a state might be more amenable to them. And you might expect states to issue some more tax amnesties, trying to get taxpayers to voluntarily come forward in the future. All right, that concludes my discussion of the other states. So here's your second CPE question. States conform to the IRC as of the current tax year. They conform as of the date of their conformity statute, or they can select which provisions of the code they adopt, or all the above. All right, hopefully everyone's had some time to think about this, and hopefully everyone got D as their answer. And hopefully everyone is still watching. Okay, so I've mentioned this Public Law 86-272 a few times, and for the lucky ones of you out there, you don't know what this is, but what this law is actually a very taxpayer-friendly law. It is a federal law, dates back to the 50s, which basically says that a taxing jurisdiction, a state, may not, that is very important. That's a big error. Yeah, no taxing jurisdiction may impose an income tax on a taxpayer whose only contact with the state is soliciting orders for tangible personal property that's approved and fulfilled outside the state. So to put it differently, a seller of tangible personal property cannot be subject to income tax in a state if their only activity with the state is soliciting sales. So that fits perfectly with the internet retail boom of the last 20 years or so. You're sitting here in Texas, you got a website, people can order their stuff, you ship stuff all across the country, and then you get to tell every other state, hey, I don't have to file any income tax returns there because I got no employees doing anything in your states other than soliciting sales, if that much. Um, so this has been the law for pushing over 60 years now, and it really seems ill-equipped to deal with the new economy, certainly new compared to the 50s when mailing catalogs across the country was revolutionary. So there's the body out there known as the Multi-State Tax Commission, the MTC. And they're kind of a group that tries to streamline things between states, try to make state taxes consistent and easy to deal with as possible. And so states will often adopt their model regulations or statutes in their codes because they know that someone has given them thought and they make sense and they kind of jive with other states. Well, the MTC is currently revising its view on Public Law 86-272, and their new guidance is going to be more friendly to the states, where they're going to arguably treat remote service activities and even putting cookies on a customer's computer as being too much of an activity within that state that you would lose your 86-272 immunity. So here's what they've proposed. They recently had this meeting and they announced this new language where they would say, as a general rule, when a business interacts with the customer on their website or app, their business is engaging in a business activity within the customer's state. However, when a business presents static text or photos on its website, that in and of itself does not constitute a business activity within those states. So what that's basically saying is if you just kind of have a static website, then you're not doing anything in the state, but you do anything more. If you have the ability to take orders from your customers in the state and you're putting as small an activity as putting a cookie on their computer, which I think is pretty much every website at this point, then you will have gone beyond the protected activities in that state and you would become exposed to income tax there. So that would basically eviscerate and make 86-272 worthless for most taxpayers who it's helping right now. Here's some examples they give of what would be unprotected activity. Helping a customer after a sale with online chat or emails, soliciting online applications for branded credit cards, a careers page that accepts applications for non-sales positions, remote product patches, updates, selling extended warranty plans, or the sale of streaming music or video services. So not everybody is going to do one of those things. So it's still possible that you can be, even as they revise this language, that you might still be protected by 86-272, but with the states needing revenue and with them typically relying on the MTC interpretation of this law, you can fully expect that states are going to start arguing that, hey, you violated 86-272 and you owe us tax. As a separate matter, I mentioned telecommuting in the other slide, and some states pretty much touch on this. To the extent that that person is not a salesperson, then they would be conducting an unprotected activity in that state by having an employee in that state. Some states are probably going to be okay with that as long as it's temporary, virus related and not a regular basis. So for those of you who are retailers again, this only relates to sellers of tangible personal property, which is a very important fact. If you're a service provider, none of this applies. Or if you provide services above and beyond your sale of tangible property, then you also might already be conducting unprotected activities. But basically right now, if you think you're currently under there, you want to make sure to the extent possible that you stay protected by this Public Law 86-272. You might want to review your website activities to see what services you offer on there and whether those would be potentially unprotected activities based on this new guidance. And it's draft new guidance, to be clear. This isn't kind of a done deal yet, but it's getting that way. This kind of comes on top of the Wayfair decision from a couple years ago, which broadly expanded where taxpayers have to file for sales taxes. Well, if you've registered with the state for sales tax and you haven't paid income tax there because of 86-272, you very well might be doing it right, but it's easy to imagine a state saying, all right, I got a nice list of low-hanging fruit to go after, to argue with and tell them they should be filing income taxes. And so, you know, I would not be surprised if those types of states start contacting you. You might wish to be proactive about that. And, you know, if you think you're going to get busted by a state, you might want to consider doing a VDA, or sometimes states will offer an amnesty period. A VDA, just to be clear, a voluntary disclosure agreement. You basically come forward to the state, and since they don't have to expend their resources catching you, they give you favorable terms, which usually involves only going back 3 years instead of arguably to the beginning of the date you began doing business in a state. They certainly will waive penalties, and some states, including Texas, would waive interest. One thing you might want to think about is, for state tax purposes, if you have, the only way to take an NOL for state purposes is to have generated the NOL at that state level. So what that means is, if you might, let's say in 2020, you're at a loss due to, you know, due to the virus or any other reason, but you fully expect to rebound next year, you might want to consider filing in a state now where you have a loss, where you'll be able to preserve and create a state level NOL that you'll then be able to use on your filings, you know, for future years. So even though you might think it's not worth filing this year, you don't owe any tax, and to be clear, this year, I mean 2020 to be due next year, you know, it's something to think about strategically in terms of minimizing your taxes in the future, if that seems to be kind of how your business operations should, you know, rebound, and that makes sense. And now for the last question, Public Law 86-272. It applies only to sellers of tangible property. It overrides any state income tax filing requirements. It may be weakened in the future, or all of the above. And hopefully everyone got the same answer as they did in the past, which is D. And hopefully everyone is still watching. That is everything I had wanted to talk to everybody about. Hopefully that's helpful to you all. And if you have any questions, I'd be happy to answer them now. And if you have any questions after we end here, please feel free to reach out to me. And I'll be happy to try to help you. I'll wait a few minutes and see if any open questions come up in the Q&A tab.
As we're waiting, please enter any questions into the Q&A function at the bottom of your screen, and John will be able to answer them there. Just some housekeeping. Please remember that the survey will also pop up on your browser at the end of the webinar, immediately after you exit. An email will also be sent to you tomorrow at 11 with this survey link, as well as the link to our YouTube page that you will be able to find this presentation. Thank you, John, for such an amazing presentation, and we'll stay live for a couple minutes as people ask any questions. The presentation will be in the survey. You will be able to download immediately after you complete the survey. If you have any issues with that, feel free to reach out to us at askus@lgt-cpa.com, and I'll be able to help you with that.
Let's see, I do have a question popped here. I have an online business in Dallas. The products are produced and mailed from Tennessee. Is tax due wherever the product ships or in Texas? The answer to that question would be based on whether you have a nexus in other states, which would be based on this Wayfair decision, which was a Supreme Court case a few years ago. Basically, the answer is each state is, you know, now, forget about the past, but going forward, if you cross a certain dollar threshold of sales in a particular state, then you have a sales tax nexus there. It used to be you need to have a physical presence, but now they kind of just look at the volume of sales. So most states it's $100,000 or more. So my answer to that question is, if you have sales over $100,000 into a state, leave aside the question of whether those sales are taxable, wholesale, whatever, just gross amount. If you have over $100,000 of sales in a state, you should be concerned that you have a sales tax filing. And I'd be happy to, discuss that further and give you the actual by state, what those thresholds are and things of that nature. There's a second question here. If you offer services to residents of other states, your income is never subject to income or sales tax. No, that would be incorrect. So if you're a provider of services, usually those services won't be taxable, but that's just usually. The way most states work is you sell tangible property, it's taxable unless there's an exemption. If you provide a service, it's taxable unless it's specifically listed in the statute as taxable. So it's kind of the burden of proof switches. So most states don't tax most services, but obviously that is a very broad statement and certainly not true for every service and for every state. So services are sometimes subject to sales tax, and certainly if you're generating income in another state, just as I mentioned, these dollar thresholds for sales tax, a lot of states kind of have a similar approach now for income tax. I don't want to say that too strongly because states are all over the map, but you're never not subject to income tax in another state because if you're providing services, there's no protection for you unless you just simply don't meet their nexus standard. Yeah, and just following up to Leon, if you don't have sales over $100,000, as a general matter, I wouldn't worry. But hopefully your business will cross those thresholds in the future, and you should be prepared. You'd want to be proactive about it and make sure you are doing what you should be doing, because it's a lot easier to ask your customers for resale certificates or to kind of put them in your system as taxable now than it would be years down the road if you're being audited and you got to kind of do all that stuff after the fact. That would be my advice.
If there are no more questions, John, I think we can go ahead and wrap it up. Again, thank you everyone for attending, and thank you, John, for that amazing presentation. As I said before, if you have any questions regarding this webinar or any of our services, please email us at askus@lgt-cpa.com, and we will make sure that the right person gets your message. Thank you, everyone, and have a great day.
Thank you, everyone.
Thank you for joining us. As this situation is constantly evolving, please make sure to follow our events page for more information. Link is in the description below, along with other important links, including our social media. If you want to see more Lane Gorman Trubit financial webinars, make sure to subscribe and hit the bell icon for notifications. If you want to see more of our COVID-19 webinars, link for the playlist below.